Bloomberg Audio Studios. Podcasts, radio, news. This is the Bloomberg Surveillance Podcast. Catch us live weekdays at 7 a.m. Eastern on Apple CarPlay or Android Auto with the Bloomberg Business app. Listen on demand wherever you get your podcasts or watch us live on YouTube.
This is a joy and exceptionally well-timed. Wei Li is prodigious in mathematics out of her China and, of course, out of University of Cambridge as well. She was a former trader in equity derivatives at Citigroup. You've seen her on the show Industry. Joining us now from BlackRock, Chief Investment Strategist Wei Li. Wei Li, what a tour de force out on LinkedIn on the cash path of the risk premium. I can't say enough, folks, how the partition between the short-term cash path and the longer duration focus of the media, the Fed parlor game, is apt. Wei Li, why should we focus on cash and the cash path?
Absolutely. Good morning. Thanks for having me. So as we think about the increase of 10-year yields, it can be broken down into the increase of cash path and the increase of term premium. Term premium increase doesn't have to be negative for equities, but the misunderstood fact is that markets look at 10s increasing and automatically expecting equities to come under pressure. So what I really care about in terms of translating rate moves into its impact on equity is how much of that increase in 10-year yields is driven by cash path. And so far, not a huge amount, some of them, but not a huge amount.
Right.
80%, more than 80% of the increase since the September lows in 10-year yields has been driven by term premium, which means that equities can still hold up, especially in the face of strong growth.
What do we see, Wei Li, in terms of flows into money market funds? We go 6 trillion, 7 trillion. Do I need to prepare for $10 trillion of money market funds to buttress the cash and the cash path?
Well, right now, there is value to seek income in the front end of the curve. You get income, you don't take a huge amount of duration risk. I can absolutely see why flows are going into money market funds. Now, having said that, so far this year, we got a flavor of how long end repricing can quickly steepen the curve and potentially make duration attractive down the line. We expect yields to push higher still, but at some point it will get to a level that even we would find it attractive. You know, we think terminal rates settle round about 4%, term premium fair value round about 100 basis points. You add the two together, 5% 10-year yields could look attractive. We're not there yet, but which is why we're currently underweight U.S. Treasuries.
Wei, thanks so much for joining us this morning. I am such a huge fan, and we're both believers in the higher for longer narrative. With everyone so focused on rising real yields and stable break-evens in 5s and 10s, I have to say, I think they lost a little bit of track of the inflationary pressures emanating from the front end. And I'd like to hear your thoughts about this week's sharp turn lower in real yields, not just in the front end, but along the whole curve. Is it durable, and where do you see U.S. growth expectations settling here?
We expect U.S. growth to be in the mid kind of 1.5% real growth for 2025, which is slightly lower than consensus, but resilient, certainly strong, with potential to the upside, depending on the fiscal side of things. Now, having said that, yes, we have seen wild swings in inflation expectations so far this year. You talked about the inflation print this week and its impact on break-even pricing, but let's extend slightly further back to last Friday. We had NFP. Headline job creation was slightly stronger than expected. Wage was well behaving, and yet markets were immediately reading into greater job creation, higher inflationary pressure. So even though I had the view of high for longer for a while, I didn't think that represented additional inflationary pressure, and yet markets are very, very quick to swing wildly in between narratives. And I think this is going to be a hallmark of 2025, because we don't have a firm anchor, and markets are trying to fit structural forces, structural patterns into a cyclical lens. We're going to have a lot of macro volatility.
Wei, I know you're an advocate of staying underweight duration in the current environment, and I loved your chart on LinkedIn where you compared index yields versus duration. But I wonder if you could expand on that a bit, because look, staying underweight duration in U.S. Treasuries, while that's cute, not John Tucker cute, but cute nevertheless, building short duration exposure in high beta asset classes like credit or mortgages, that could prove interesting as well, no? So I'm just asking, from your clients, what are you seeing? I mean, where's the best risk reward for hawks like me who prefer to remain duration light?
Front end of the curve right now we favor, and we also like investment grade, but short duration investment grade. The spread of high yield is a little bit more interesting than an IG, so we can term out a little bit in high yield space, and value can be found in European credit versus their US counterpart. So this is where we like for kind of income within the fixed income space, but we are 2 out of 3 overweight in US equities on a scale of -3 to +3. So that's quite overweight in US equities, despite the volatility that we have seen so far this year. You look at the drivers of earnings, Magnificent Seven, they're net negative in terms of net debt. They're negative in terms of net debt. So they're quite resilient in the face of rate volatility. So we continue to see US corporate strength carrying us through.
Right. We continue with Wei Li of BlackRock, Ian Bremmer to be with us in the 9 o'clock hour, Katy Kaminski, Jim Caron, Carl Weinberg in the 8 o'clock hour. An extraordinary surveillance this morning. Good morning on your commute across the nation. Particular good morning to 99.1 FM, preparing for an inauguration Monday. I'll give you details on our commitment to that. You'll see that Monday from Joe Matthew and Kaylee Lines. Good morning on YouTube. It is the best way to get us, particularly across the nation and internationally, after your commute. In the BlackRock office, consider YouTube. We continue with Wei Li. Wei, one of your great themes, which frankly I endorse, is that we're not going to do a simplistic revert to the mean attitude. There's a feeling, to give John Williams just due, that we go back to 2%, we go back to trend, everything is pre-pandemic nice. You forcefully push against that and look for a reset higher. How do equities reset off the fixed income new reversion to the mean?
One way to look at it is indeed rates are resetting back to the high for longer than equities need to reflect that reality, that new rate reality. One measure, so to your point, Tom, around mean revert, one measure that I get quoted back to me constantly is Shiller PE, that it is at the 3rd highest level ever on history, just after global financial crisis, just after the end of 1920s, roaring 20s. Right now, Shiller PE is 37 times, and that is indeed quite stretched. But if we were to put consensus forecast for earnings as backward realized earnings for the next 10 years, then Shiller PE becomes 17 times instead of 37 times. So all of that just to say, in the face of transformative forces driving economies forward, driving earnings forward, especially tech, and as that broadens out to the rest of the economy as well, the earnings wouldn't look as stretched. So I cannot agree with you more, agreeing with me that mean revert is not the playbook.
I think it's too simplistic. And folks, this goes back to a paper by John Campbell and Professor Schiller of Yale University, who everyone knows I adore. This is back, I'm pushing 40 years now, before Wei Li was born. And the answer, Wei Li, is if you look at Campbell Schiller, they don't really model in a technological shift, a productivity shift. Are we pricing in the present productivity and our present new technology? Is that our great misjudgment?
I think that is starting to be priced in, but depending on the ultimate magnitude of productivity boost, there can still be further upside, especially because right now, in terms of the economic data, yes, we see sector-specific productivity gain, but we have yet to see economy-wide productivity gain being definitively driven by AI. So the upside is still there. And currently, literature review has a wide range of productivity boost, somewhere between 0.1% per annum to 1.5% per annum. So that's a wide range. There is certainly more room to surprise to the upside. In our assessment, we're still in phase one of the AI revolution. Phase one being the build out phase. Then we have phase two being the adoption phase, where we're expecting use cases to really broaden out across sectors, and phase three being the productivity boost, which will take time.
Wei, we're 3 days away from Trump's inauguration, and everyone knows that the U.S.-China relationship is front and center. We saw some activity data overnight. We saw them hit their 5% bogey for full year 24. Talk to us about 60% tariffs on China. How does dollar yuan react? And more importantly for me, as the emerging market strategist here at Bloomberg Intelligence, what does that mean for the broader Asian dollar bloc? I mean, can we expect Asian currencies to depreciate over the next quarter, let's say?
I think all else equal, greater tariffs leads to weaker currencies, which is why the yuan has been under pressure so much so far this year. And more broadly, tariffs concern is why, even though data from China is stabilizing and overnight data particularly was reasonably resilient, markets don't seem to care. Markets don't seem to care, and investors don't seem to care. One little known fact, I was looking at it at the end of last year, just reviewing yearly performance. In dollar terms, Chinese equities and Chinese government bonds outperformed their U.S. equivalent for the year of 2024, but investors don't care. Plummeting bond yields in China shows that investors are really worried about decades of deflation doom loops. So I think this is really a sentiment and confidence game at this point.
Right. I mean, this is great. We could go for 4 hours with Wei Li.
Let's do it.
Are you going to give her a co-write on your morning note?
Well, me?
I
mean, look, I'm not going to write my note until this weekend, but Wei, you're going to be front and center. I mean, I have to keep going here. I mean, for me,
please,
how do you not ignore the fact that once the PBOC starts allowing the yuan to kind of float up to 740, 750, that you're not going to see some spillover? We just saw the Bank of Indonesia cut rates and look what happened to its currency. We're at an all-time low relative to the dollar. I mean, can we expect the Korean won, the Indonesian rupiah, the Philippine peso, are they all going to start testing lows versus the dollar? Is this going to be a regular occurrence for the next year plus?
Well, what we have seen so far after the election is that the dollar has been very, very strong. But I would say, though, for the entirety of the first Trump term, dollar actually hasn't been that strong. So it rallied into inauguration and starts to kind of go sideways, right? So I wouldn't necessarily extrapolate the dollar strength indefinitely from here on. And also, as we think about the goals of the Trump administration around kind of stronger growth, lower inflation, lower deficits, and lower immigration, there is a market-friendly way of getting there, and there is a market-less friendly way of getting there. So depending on which way we are gravitating towards, it has significant read across to the dollar for sure, to U.S. equity sentiment, to treasury yields.
Right. Wei Li, thank you so much. Across the nation, on YouTube, worldwide, Wei Li of BlackRock. Greatly appreciated this morning.
You're listening to the Bloomberg Surveillance Podcast. Catch us live weekday afternoons from 7 to 10 a.m. Eastern. Listen on Apple CarPlay and Android Auto with the Bloomberg Business app. Or watch us live on YouTube.
I will not be at Davos. And if Dr. Klaus Schwab's people came to me and said, do a panel, this is the year where I would say, I want to do a panel, but I want it to be just one person. And it would be Ian Bremmer. Every year, he and his team, John Lieber among others, put out a thing called the top risks. And it's not funny. It's a really serious look at where we are going into a given year. And it's remarkably prescient. Some things he gets wrong, but huge amount of, OMG, how'd you do that? Like Merkel in Germany years ago. But he's really outdone himself this year, hearkening back to his classic G0 of 2012. Dr. Bremmer joins us this morning. Ian, I'm just going to cut right to the chase. The summation of your top risk 2025 is a reversion to the 1930s. How close are we to the 1935 of Hermann Vauch's Winds of War?
Well, we're close to the 30s and we're close to the 50s. So in other words, the trajectory is not sustainable. And the question is whether the crisis that's coming is big enough to make us pay attention, but not so big that we all end up fighting each other, right? I mean, in the early Cold War, we had this unfettered decoupling and arms race between the Americans and the Soviets, culminated in the Cuban Missile Crisis. We almost blew ourselves up. And then we started recognizing we needed, like, actually to have some institutions that would create more stability between the two countries, arms control hotline and the rest. You see shades of that, and you also see shades of the 30s with a United States that's incredibly powerful, but is unwinding its own global order, its own institutions.
Right.
I mean, you look at things like the United Nations and the WTO, and these are organizations the Americans put in place to coordinate global governance, and that now Americans don't believe in. So it's not clear, but it's clearly, as you say, Tom, this is a definitive moment.
Ian, what's so important here, and I lived this, my grandfather was a textbook Chicago Tribune isolationist of middle America, and you go back to Lindbergh and the rest of them. What is the character of President Trump's isolationism?
I don't think it's isolationist. I think it is strongly unilateralist. And so it's not that the United States is saying we're only going to focus at home. I mean, you know, the Panama Canal and Greenland and Canada comments don't feel isolationist to me, but they're deeply transactional. And in many ways, Tom, what we have is that the Americans are embracing the Chinese worldview that has served China so well over the last 35 years. It's transactional. It's not about rule of law. They don't care what your political system or economic system is like. They will engage with you bilaterally with the intention of being more powerful than you, and therefore you have to play by their rules. And what the Americans are saying is, actually, China, we can do that, and we can do it a lot better than you can, because we're a lot stronger than you, by the way. And that's really what Trump is saying. And it does come at a time when America's adversaries, Russia in deep decline, Iran having lost their empire by proxy, the Chinese in the worst economic conditions since the 90s, maybe the 70s, are particularly weak. So it's an interesting moment to try this experiment. A lot of things are probably going to break as a consequence.
Dr. Bremmer, your Eurasia Group's top 10 risks are required reading at the beginning of every year, and this year's is no different. U.S., China, Russia, Iran, Mexico, I mean, you name it, they're all in there. You know, the one country that I didn't see in there was Syria, and I'm curious to hear your thoughts on what the fall of the Assad regime means for the Middle East and the rest of the world more broadly. I mean, seriously, what role should America play in restoring order to a nation where 14 million refugees were forced to flee their homes in the last, call it 15 years. I mean, a nation whose geostrategic position is so very important to health in Central Asia. What are your thoughts there?
So Syria's there, but it's underneath the number 9 risk, which is called ungoverned spaces. And we include Syria and Yemen and Libya and Haiti and Myanmar.
Western Sahara.
And Sudan, by the way, which is a lot more important in terms of numbers of lives than what you just mentioned in Syria. And yet no journalists on the ground, and they're fleeing mostly to neighboring African countries as opposed to Syrians who go to Turkey and go to Europe. So we don't pay as much attention to them. And that's kind of the point, right? Is that, I mean, the danger in Syria, where the Americans had slightly more than 2,000 troops on the ground, and under Trump are likely to remove them and say, Turkey, you mop it up, is that if HTS is incapable of running a unifying government in Syria, which is, a reasonably plausible outcome, then you can easily have a big part of Syria that's ungoverned and would be fodder for a new ISIS caliphate. And over time, not 2025, and this report's for the year, over time, of course, that's something that will wash up on our shores too.
Ian Bremmer with us here. We're thrilled to have him here to celebrate his top risk. It's a team effort from Eurasia Group each and every year. He'll be with us for a good amount of time. June Grasso to join us here in a bit on this important Chinese social media thing, which I don't understand. Dr. Bremmer, one of the moments that stands in time for me is Ian Bremmer and Robert D. Kaplan with me together talking about a G0 world within Kaplan's Revenge of Geography. What is the most constructive path for moderates in America to get out 4 years, or dare I say 8 years out? What is the initiative that needs to be taken? Do we need to take Kaplan realist policy?
Well, it's not about foreign policy so much, although it is true that a lot of people that decided not to vote, that had voted for Biden last time around, report that Biden's position on Gaza / Israel was a significant thing that turned them away from the polls. And that's a place where Elon Musk and his targeting of very specific and important districts that were swing in the United States could have made a difference. But leaving that one piece aside, and it's not unimportant, of course, I would say most Americans are not going to the polls on the basis of Biden or Trump's worldview. It's more about what they're doing and what they're rejecting at home. And the fact that Trump has become a leader that attracts more working and middle class Americans because they feel like he's more interested in their well-being. The fact that he was able to get a significant majority of labor union voters in the United States, while Harris was, the candidate for urban, well-educated elites. And that's not a sustainable path for the Democrats, in my view. So they clearly have to reassess a lot of their platform that did not appeal to the average American that did not feel taken care of. More billionaires put money into Harris's campaign than did Trump's. That tells you something.
Dr. Bremmer, the U.S.-China relationship's at the forefront of geopolitical risk in the current beta regime. Yet if we do see something like 60% tariffs, do you really think that China's going to allow the yuan to debase itself again? And if that does indeed occur, do we feel there's a clearing price in dollar yuan where the market can go to that can still allow China to grow at 5% per year?
I don't expect China's going to grow at 5% per year over the coming several years. I think they've got deep structural problems that are being made worse by the fact that the only part of their economy that is overperforming is their manufacturing export, which feels like dumping. It's $1 trillion surplus, and it's upsetting lots of countries around the world, not just the U.S. The U.S. is leaning into hitting back, which will occur with tariffs, though it won't be a 60% number. I mean, the top line election campaign numbers are never the numbers we see. But even if it's 25%, which I think is more plausible in the early weeks and months, you're not just talking about U.S.-China. You're also talking about the Americans squeezing other countries. We've already seen this with Mexico. We will see it with India, with Southeast Asian countries, for acting as a pass-through of Chinese exports to the United States. So it's very hard to imagine that U.S.-China relations are going to maintain the comparatively well-managed, sort of incremental decline that we've seen in the last year and a half under the Biden administration.
I want you to sit on this question, Ian, because I think it's so important to all of our listeners and the people that, enjoy so much your international relations. This harkens back to the fear of the first week of August, 1941. A bunch of boats sitting off eastern Canada where Roosevelt and Churchill tried to begin to piece together the post-World War II world. And they were humbled by two major wars. The thing out there, Dr. Bremmer, is the only way this is going to get solved is the humility of a war. Discuss that. Is that what it takes to get away from the madness we're living in right now?
I think in the near term, we're talking about damage control. We're talking about countries and companies on defense. So, a lot of them are hoping that they just don't make headlines. Others are trying to figure out what they need to do proactively to kiss the ring. And geopolitically, you're going to see a whole bunch of countries acting the way Mark Zuckerberg has in the last week, towards the commander in chief and towards his bomb thrower in chief, Elon Musk, by far the most powerful person around the administration, if I can call it that. Look, I mean, the way that you respond to a G0 world is either you reform and strengthen your existing institutions so they are more fit for purpose. You build new institutions that better reflect the demands, the opportunities, and the concerns of the present age, or you go to war. And I can give you examples of all three. All three are happening. We are strengthening NATO right now. We are creating new institutions, the Quad, the Chinese are building Belt and Road, and the BRICS, and, there are other examples.
Right.
But the most energy is going into more conflict. The most energy is going into more war. And again, that is not geopolitically sustainable. So I think, your advice to other countries right now, given the power imbalances and Trump coming in and how consolidated his authority is inside the United States compared to 2017, where, he was riding the Republican Party's coattails, his administration felt very different. Not this time around. He's the guy, is that they have to recognize they're playing defense. And defense is more effective in depth. It's more effective if it's strategic, if you're not just, reacting to the latest headline, and it's more effective in numbers. In other words, the EU is better off than, say, the Mexicans because they can act collectively. And to the extent that other countries are capable of doing that in defending the things that matter to them, both in their own countries, but also in terms of international architecture, we will all be better off. By the way, Trump is going to get a lot of wins in the next year. But unlike Xi Jinping promoting a Chinese worldview, Trump doesn't get to do this for 20 years. He gets to do it for 4, assuming he's in good health. And then he doesn't anymore. So long term, the United States unwinding its own institutions does not strike me as strategically smart.
Okay, got to leave it there. Ian Bremmer, congratulations on the impact, the effect of your top risks for 2025. Of course, Dr. Bremmer with Eurasia Group, and I think it'll be a source of great conversation here.
This is the Bloomberg Surveillance Podcast. Listen live each weekday starting at 7 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
This is a joy. Katy Kaminski joins us right now. Thrilled that she could be with us in Boston because she is the queen of the trend and of the effort to extrapolate. Katy, are trends in place right now at AlphaSimplex? Like, do you walk in and say, this is the trend, I got a feeling of where I am now?
They have been until this week, I have to be honest, because trend following has been working very well, particularly in currencies and also fixed income. But I think this week sort of marked a little bit of a shift in sentiment, particularly for fixed income. But the trend in the dollar seems to be very much in place. And that's something that is surprising and exciting sort of to follow.
What's the inertial force there? I'm sorry, Damien. Is it, on the dollar strength, Damien's
I get so excited when anyone talks about the scope for dollar strength.
But Katy, what is the nature of that trend? Is it a momentum? Is it a bid? Or is it a lack of people pushing the dollar down?
Well, I think, I tend to think about the dollar as having a few key forces. One is monetary policy, another is sentiment, and the third is, of course, growth. And so since we've seen that the dollar has been persistently strong, especially going into the election and post-election, that seems to be a pro-US, pro-growth story. Then this month we saw sell-offs in equities, which tends to be pro-dollar as well. And then finally, monetary policy had been a little bit more reticent recently, which is also pro-dollar. But what surprised me is this week, given sort of the shift in sentiment on the Fed, actually the dollar hasn't really wavered. And it didn't waver last month either. So it looks like this theme, pro-US and sort of US dominance is probably one of the stronger themes that we're seeing that's holding through all the noise.
Katy, you're on the managed futures strategy at AlphaSimplex, the global alts strategy also. But let's talk about futures for a second, because I need to dial it back to the early 2000s, to my CTA days. I need to think about Campbell, Winton, JWH. Talk to me about what the state of the market is now. I mean, those guys are long gone. I mean, we know the macro guys used to frequent that market, the Tudors, the Soroses. Like, who is trading? Who is trend following
so what
today?
You're saying right now, who is the new Monroe Trout?
Who's the Yeah, exactly right. Who's taking the marginal risk in futures markets? Who's playing mean reversion, trend, momentum, all of that stuff?
Well, I think there's just been a changing evolution of different CTA players in the space. I mean, if you look sort of Man Group, AlphaSimplex, if you look at the SG Trend Index, those are some of the largest futures traders out there. So that has evolved over time. But what's really cool about this space is that the strategies still remain, they tend to work over long horizons. And a lot of the techniques that worked earlier when there were less futures markets are still working today. And now there's more futures markets to trade. So it's actually quite, it's evolved, but it's still sort of the same ecosystem.
And I think, correct me if I'm wrong, but it seems like the market's evolved because the strategy used to be very, very volatile, right? And now you're in a different place, right? I mean, so talk to us about how you engineer, risk-adjusted performance. How do you keep vol low? How do you dial down volatility when you're practicing such a volatile strategy inherently?
So in our world, what I think is really cool about futures is we think about the world as allocating risk instead of dollars. And so the way that we think about managing risk is really about measuring the strength of sort of each of the markets we trade and adjusting that for the size of the volatility of that particular market. So in some sense, it's sort of like a long-short risk parity strategy where you're managing how much exposure you have to different assets. So for example, cocoa is very volatile, but short-term debt is actually not that volatile. So when you combine these things together, you need to measure sort of the relative strength of them and then also adjust for the sizing that makes all of those positions better behaved.
Nicely said. Just jump in here, Damon. You're all fired up here.
Well, I mean, we're in a very different environment also in that rates are high, right, Tom? So the embedded leverage within futures and forwards, I mean, it just changed.
No, come on. The free lunch of the last 6 years is gone.
So how does that impact the strategy, Katy? How do you look at the inherent leverage, the funding embedded within your strategies?
Well, this is a great question because most people don't understand that futures markets have implicit leverage instead of explicit leverage. And what do I mean by that? Is that when you use futures, you implicitly get leverage in those commodities or those futures on equity indices without having to borrow cash. It's implicit in the futures contract, which means that 80 to 90% of your capital is actually in collateral that earns cash yield. So we basically have a carry that we didn't have in a low interest rate environment. And that sort of means that you can be more effective with your collateral.
Katy Kaminski with us, AlphaSimplex, an extended conversation this morning. Ian Bremmer will be with us in the 9 o'clock hour. Just power-packed show today. Thank you for being with us on your commute across the nation, on Apple CarPlay internationally. And of course, I must say on YouTube, subscribe to Bloomberg Podcast. Katy, are we competing away, diversifying away, and hedging away total return? We featured yesterday a number of non-trend, non-CTA hedge funds with single-digit returns, and you can rationalize that, except I got growth portfolios up 30% and SPX up 20%. Plus, at AlphaSimplex, how are you rationalizing single-digit hedging versus a lift in the market?
Well, I think the challenge is, and there's twofold. One is the market has been up quite a bit, so obviously directional strategies might work better, but you also have an environment where borrowing is more expensive, so sort of leveraging up relative value positions can be more challenging. And I think this is sort of the slow migration that we're seeing.
What are you seeing in the equity market? I mean, I know it's away from the heritage of CTAs in foreign exchange and commodities, but do you believe in the American bull market?
Well, what you're seeing is, I mean, especially the growth numbers and some of the fundamental data is definitely consistent with the technical views, where you see that the U.S. signals have been much stronger. And you mentioned sort of single name equities. What we've seen a lot of single name equity strategies have worked very well in the last year or so because of the dispersion across different asset classes, or not different asset classes, but different sectors, and just this sort of big Mag 7 versus the Russell and other sort of idiosyncratic themes across equity markets. So it's been a fun place to be as a technical or systematic trader.
Katy, last question from me. I mean, let's delve into commodities a bit, and it's a very different place now, right? I mean, I remember the good old days, right? When Cargill and Archer's Daniels and basically those big, old stodgy beasts, took them a year to turn in the sea and we could kind of pick them off. But that's not the case anymore now, is it? They're very sophisticated trading shops, right? And they are really the marginal risk takers today in commodities. Talk to us a little bit about what signaling they're giving you in this market. How are they behaving? Are they behaving rationally, or are they trying to get ahead of these tariffs?
Well, I think, if you look at how commodities have moved, commodities have been really sort of in an uptick, particularly energies more recently. My guess is that, if you believe in price discovery, these type of players are really sort of analyzing that information and bringing it into the market. So commodities, you're right, they're still complicated because one futures contract on one commodity is a different commodity than the next one. So they're more complex and they're more seasonal. But, you're right. It's been a space where people have really gotten up to par.
I mean, what's really important here is she was in Boston at Logan, and she went over the Wheatstone Bridge to Cambridge and did a double E in engineering.
MIT.
And, at MIT as well, and she's visiting lecture at Sloan. When you're talking to the animals at Sloan, Catherine Kaminski, how do you tell them to not lose money?
Ooh. Don't overtrade.
Thank you. I knew, it's like a lawyer. I knew the answer before I asked the question. In this addictive financial media, Katy Kaminski, all I see is overtrading. How do you operationally say no when there's this frenzy? I got to do something. How do you pull back?
Well, this is why I've been so fascinated with systematic trading. Is the goal is you disconnect your emotional response from your actual trading decisions. And that's hard to do because in the heat of the moment, we all want to react to Tesla. We all want to react to something we read. But really that diligence of not doing that is really important.
Katy, last question. I keep saying last question, but I have so many more. I mean, talk to us really, because I'm not in the market the way you are anymore. Talk to us about the cost of trading, right? Talk to us about what, banks, I mean, I remember for years and years and years, the cost of broking, of holding custody, it was all coming down. Now it's a very different place. If I dare I say, it might be going in the other direction. Is it expensive to trade? Is that why you're not necessarily an advocate of high frequency trading? Has it gotten more expensive? Is it getting more expensive in an inflationary environment?
Well, generally, I think cost of trading has been going down. I think where the cost of trading is going up right now is with explicit leverage. So if you look at something that the biggest theme that would be a challenge, that's borrowing money is more expensive today. And that would probably be the most important cost when you're thinking about hedge funds. Because in this environment, anytime you need to lever or take two sides of a particular position, that's going to be more expensive in a world where you have much higher borrowing costs. So I think that outweighs any of the sort of themes in trading from my perspective.
We were mentioning some of the giants of CTA. I mentioned Mr. Trout of Bermuda, and John Henry, who runs a small baseball team up in Boston. Right. It was back when it was, Damien, it was Spark Stations. And which you're too young to remember this. It was Sun Microsystems Spark Stations.
I know what you're talking about.
And fancy people from MIT, this guy Andrew Lowe and others, were like, we can do this. And all of a sudden, the Bloomberg showed up, and you could pop ADX DMI over a cup of coffee. It was unreal.
I remember those pits. I mean, Katy remembers this. I mean, if you could get a guy with a little headphone in on the pit where you're trading Eurodollars, trying to pin strikes on where the Fed's going to go. Oh, these are the good old days. Yeah. Ribor, short sterling. I mean, come on, let's go.
Katy,
1 by 2s, 1 by 3s.
Good old days, or is it still about legit mathematics, technical analysis, and trend base? Is it the same old, or are we just something new?
Well, I think the truth is trend still works. I mean, it works over a long horizon and people are people. And so I think the frequencies change, but we have sort of human behavior, which causes us to overreact and underreact to news and changing environments and to be terrified by change. So I think that creates natural trends in markets. So I think it's, same. We're still the same, different technology.
Katy Kaminski, thank you so much. Greatly appreciated this morning. Got to go to some breaking news here. But Catherine Kaminski with AlphaSimplex, brilliant.
This is the Bloomberg Surveillance Podcast. Listen live each weekday starting at 7 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. You can also watch us live every weekday on YouTube and always on the Bloomberg Terminal.
Jim Caron right now from Morgan Stanley on the mix that we're in right now. Jim Caron makes sense of the first 17 days of January. No one else can.
Well, it's a tall order. I'll try. So, look, I think one of the big changes that has gone through is that we started the year very, very sure that the Fed was going to cut at least 2 times. Within about several days, we said, well, maybe it's 0. And now we're back to they're probably going to cut, 1 to 2 times. So what's really been happening is all of the action has really been at the back end of the curve. So the curve has been steepening, meaning that the 10-year yield, the spread between the 10-year yield and the 2-year yield has been expanding. It's been widening. And I don't think this is necessarily a bad thing. And I think when we look at the markets today and we say, well, bond yields are rising, I know they've recently fallen over the past day or so, but bond yields had been rising. Is that going to break the equity markets? And I think we need to ask why yields are rising and which yields are rising. And if it's the back end and it's because people expect there to be, better growth and higher productive growth with low inflation and the front end rates stay relatively pegged to where the Fed funds rate's going to be, then I think that's okay. So in other words, you could get a spread between the 10-year note and the 2-year treasury to be about 50 to even 75 basis points. So if the 2-year treasury is at around 4.2, 4.25%, it's not unreasonable to think that you could have a 10-year note that's around 4.75 or even 5%. Now, fortunately today, those yields are lower, and that's a little bit more accommodative, and that's okay. But the market is building in this extra term premia because of this uncertainty about the new administration, what the announcements may be, and everything else. And the bond market has been driving the equity markets, and that's, I think, what we've been seeing.
I mean, Tom, how prescient of Morgan Stanley Investment Management to have Jim Caron, with his experience in rates, FX, emerging market fixed income, to run the ship at MSIM. Not another stock jock. So Jim, you're talking about the shape of the yield curve, not the level of interest rates. And I think that is so important. And what's the read through to the rest of the world from that? Because we are seeing term premium build back into other developed markets, other emerging markets for that matter. You are seeing curves steepen. Just what's the runway for steeper curves here, not just in the U.S., but abroad?
Yeah, so this does create a little bit of a headwind. So for example, if we look at the UK, right? So 30-year UK bond yields got to levels that we haven't seen since 1998, right? So that's not necessarily a good thing. Now, what we have to recognize is that a lot of countries outside of the US have a high level of external debt, like say the UK, which means that they rely on the US Treasury to be the price setter. The US Treasury market is the largest bond market in the world. It effectively sets the price for interest rates. And essentially, if you have long-term bonds in other countries, it's going to follow the US. So that's not necessarily a good thing. But the one thing I want to highlight, though, is that when we think about the policies that Trump is trying to put through, he's effectively saying, I want to run expansionary fiscal policy. Now, when I say that, I mean, lower taxes, deregulation, things like that. But at the same time, I also want to cut government spending, and that's what the DOGE department is all about. And if you can do that, you can have low inflation and expansionary policy. That's the trifecta. Can it be done? Is really what the question. This could be a positive.
We're going to have an extended conversation here. We're going to go to break and come back, but let me get this in, Jim Caron. I think it's too important. This weekend, you're going to be sitting with somebody who's up to their eyeballs in cash. They're scared stiff. For whatever reason. If I look at Red Sox middle relief, I'm scared stiff. Jim Caron, what do you say to people afraid to participate in the markets?
So right now, I still think that we are in the midst of a longer term protracted bull market in equities. So I would say that the equity markets, particularly the broader sectors, the mid-cap sectors, more of a broadening out, not just the Mag 7, although I still like the Mag 7, but I think the broader sectors of the equity markets still have more earnings room to run higher and effectively have higher quality growth and increases in prices and valuations in that space. So I would say, look, a well-diversified portfolio in the equity market, not just the index, because the index is going to be highly skewed to those large cap tech stocks, but something that's very, very broadly based in the mid cap sector. I think if you're a long-term investor, large cap value, for example, could be an area that you want to start to think about and look at into the future. So I'm not afraid of the second market. I'm saying start to invest. Let's go. I mean, get going. And bond yields are higher, by the way, so they also offer better return too.
Jim, this is my question for you, and it's really interesting. When you look at your phone, you're on your way into Morgan Stanley in the morning on your morning commute, and you see an email from Lauren Reeder, the incomparable Lauren Reeder, Chief Risk Officer of MSIM. Where are the tail risks in this market? Where do the black swans swim in this market, Jim?
Yeah, so it's a good point. It's been so cold; it's been hard for me to think straight. But let me just say that I'd say that the big risks are it's really about inflation, because if we start to see that inflation becomes unanchored, and if Fed policy and other central bank policy shifts from cutting rates to actually hiking rates, that is really not what's anticipated, and that could unravel a lot of things, and it could end pretty badly. So there's nothing that I can see other than something like that, because look, the economic data has been relatively strong, the jobs data has been relatively strong, the company level data has been relatively strong, earnings are good, so there's nothing obvious that's out there. Clearly, there's always geopolitical risks and things like that. But I think the risk that we have is that if we get something more like an inflation shock, so let's say if we go through the first 100 days of the Trump administration and the markets interpret things very, very differently than what's intended, you could start to see a lot of volatility come into the markets. And this is stuff that's hard to hedge, right? Because you just can't really anticipate it very, very well. But that's what I'm focused on.
Jim. Sorry about that blue button. Jim, you're the CIO
of Detroit
across...
Lions blue. You see that? This is Barr. I tried to get Buffalo Bills blue on the button, and I got vetoed.
Jim, my apologies. You're the Chief Investment Officer of Cross Asset Solutions at Morgan Stanley Investment Management, but you previously held a lot of different roles. You were head of macro, you were head of rates, FX. You were head of emerging market strategy. Talk to me about the bullish narrative for emerging markets in this market. I'm struggling with it, Jim.
Yeah, so I think a lot of things are going to start to get realigned from a trade perspective. And a lot of this has to do with some of the tensions between the U.S. and China. So effectively, when we think of the global markets, right, when we think of the S&P 500, what we have to recognize is that 41% of the earnings from the S&P 500 come from outside of the U.S., and that also includes emerging markets too. So, when we think about policies in the U.S. where we say America first, for example, that, Trump, would normally say, it doesn't mean America alone. So one of the aspects of how we think about the markets going forward is that, yes, the dollar has been strengthening. I think that the dollar strengthening has gotten to where it needs to be at this point. I don't think it really needs to get a whole lot stronger. I don't think that it necessarily will. I don't think it's going to get a lot weaker either. I think this is going to be the range that we're in. But effectively, from an emerging markets perspective, if we start to see a rise in the CapEx cycle, which we're seeing global PMIs are already starting to pick up. Yeah. The PMI sector for manufacturing has been in a recession for all intents and purposes for the past 3 years. It's been sitting below 50. Now it's starting to move towards 50 and start to rise above. That is a positive globally for manufacturing, especially for emerging markets who supply a lot of the raw materials.
Jim, Caron, one final question. Fold in the work of Seth Carpenter, Ellen Zentner, and others within economics at Morgan Stanley. The great missed call of the last 2 years has been better economic growth, maybe some form of sticky inflation, and it sums out to a resilient nominal GDP. What does a resilient nominal GDP mean for our listeners and viewers deep into 2025?
So what it means is that you can still have earnings growth rates in double digits for equity. So you could have 10, 11, even 12% earnings growth rate. Now, what it also means is that this could be more broadly based. So when we think about, let's take a look at two indices. Let's look at the S&P 500, which is what everybody looks at, and then let's look at the S&P 400, which is more of a mid-cap index, more of a heavily mid-cap weighted index. The earnings growth rate of the S&P 500 was primarily led by those magnificent 7 stocks. If you look at the S&P 400, the earnings over the past few years has been pretty much flatlined and pretty steady. So there's a big divergence in what's been happening with the large cap growth in tech companies versus the mid cap and even large cap value companies where their earnings have been relatively flat and steady. So if you have a higher nominal GDP and we have a broadening of the market, the majority of the market has to catch up. So therefore, there's a great opportunity, I think, going forward. So that's what it means to listeners, is if you get higher nominal GDP that's sustainable.
Jim Caron, thanks to the clinic. Greatly appreciate it. Mr. Caron, always with Morgan Stanley and NYU Stern.
This is the Bloomberg Surveillance Podcast, available on Apple, Spotify, and anywhere else you get your podcasts. Listen live each weekday, 7 to 10 a.m. Eastern on Bloomberg.com, the iHeartRadio app, TuneIn, and the Bloomberg Business app. You can also watch us live every weekday on YouTube and always on the Bloomberg Terminal.